In today's housing market, it's ever so important to probably take an FHA loan over a conventional loan. I'm going to tell you all the reasons why I'm advising all of my clients to use FHA or VA if they're veterans, specifically focusing on the FHA versus conventional argument. I'm going to tell you my top 3 reasons why you should go FHA right now. But first, before I give you my tips, let's talk about what an FHA loan actually is. An FHA loan is a loan that is government secured.
Like, what does that mean?
Like, is the government giving you money?
No, what it means is that the government is backing the lender. So if the lender's gonna let you borrow $500,000, then the government is saying, hey, go ahead and let them borrow $500,000 with 3.5%. That's $17,500. And if they stop making their payment, then we'll step in and we'll cover the difference. And why that's important is because FHA has a standard mortgage insurance premium. It's calculated at 0.55% of the total loan amount. So it's about $233 to $250 on a $500,000 purchase. That's key because it doesn't change with the type of credit scores that you have. So if you have a 500 FICO or an 841, it stays exactly the same. Whereas in conventional financing, it's going to differ based on your FICO score and based on your down payment amount. Now, FHA does allow for credit scores down to 500, but you're going to want to commit to 10% down. Most lenders will stop you at a 580 FICO, but they'll still keep you with 3.5% down. And that leads me into the first reason why I would go FHA over conventional. Now, I know what most people are going to say. Well, we don't want to pay mortgage insurance. But in today's era, in today's economy, mortgage insurance is actually really inexpensive. FHA mortgage insurance allows you to come in with only 3.5% down. Again, that's $17,000 on a $500,000 loan. And that's key because in today's economy, you just don't know what's going to happen to housing. Housing has been on an absolute bull run for the last 10 years. The markets have exploded and house prices have gone up in value so high that it's almost unaffordable for people to even think about buying a house. The average price in California is about $800,000. That's insane. That's about a $7,000 payment on an FHA loan. But why that's key is because if house prices go down in value, you've only committed 3.5%. So for example, if you have a $500,000 house and you came in with 20%, $100,000, and your house goes down in value to $400,000, that's probably gonna hurt a lot more than if you did an FHA loan, you did $20,000 as a down payment, and now the house went down in value $100,000, but it's all right. Like, you were only in for 20 grand. At the end of the day, guys, the value of the property is just one giant fugazi. The only time the property value matters is when you're going to sell. So just ride out the wave. Eventually it'll recover. But that very thing actually leads me to my second point. And this is probably one of the most important points, so you're gonna wanna pay attention. If you're getting a conventional loan with today's rates, your rate is almost 7%. An FHA rate is at 6.125 and even as low as 5.75. With FHA, as rates go down, you're able to refinance regardless of the value of the property. There's just a couple requirements that you're gonna have to be on the lookout for. Your FICO is gonna have to be at least 640, and you're gonna have to make sure you've made at least 6 consecutive payments. So let's say you bought a house today, we're in August of 2024. Your first payment doesn't start until October of 2024. So let's count it out. October, November, December, January, February, March. So after you've made your March payment in 2025, right after the Super Bowl, in April, your lender's gonna be able to refinance you. You're gonna get to skip the April payment and skip the May payment and then restart your loan in June. Let's just say the economy absolutely crashes and your $500,000 house is now worth $400,000. FHA Streamlined refinances do not require an appraisal. So the value of the property is not going to impact your ability to refinance. Whereas if you had a conventional loan and you came in with $100,000 and the property value dipped $100,000 and rates dropped to 3%, you're not going to be eligible to refi that 7% because the appraisal isn't going to support the new value. And so you're going to be upside down and you're just going to be stuck. So it's ever so important right now with the uncertainty of this time to come in with as little as possible and stick to a government loan that's going to allow you to refinance the rate as rates get better without the impact of an appraisal. Now, I talked about rates a little bit, and that leads me to my third point. When I first started this video, I talked about interest rates, and I briefly said how much lower FHA rates were over conventional rates. Because FHA loans are government secured and there's mortgage insurance on them, the lenders are actually able to offer you better rates. In general, a FHA rate is almost 1% better than conventional financing. And as rates start to drop, the spread gets even bigger because you're able to streamline, and the lenders like to refinance loans and get them off of their books. So they offer pricing incentives to make it more lucrative for the individual to refinance. So to wrap this all together, if you're out there and you're thinking about buying a house and you just don't know where to start, go ahead and shoot us an email down below. Subscribe to the channel because we're putting out tons of information to keep you updated on this current housing market. Make sure you comment any topics that you want me to touch on, but feel free to reach out to us, guys. We're here to help, and we're here to answer any questions that you might have. FHA loans, in my opinion, right now are the safer bet over conventional. And that's coming from a guy who's been doing this for 10 years and has been at the top of the market for 6 to 7 years of his career. I appreciate you all. Much love, and I'll talk to you next week.